All right, welcome back. On the previous video, I basically broke down the movement of price action and how the higher highs, higher lows, lower highs, lower lows work together with the area of resistance and support. So basically how price moves through those two areas. Now we're going to talk about another concept which is called the trend line. Now the trend line, I like to think of them as a diagonal area of either, you can call them an area of support or area of resistance. It doesn't really matter, it does the same thing, right? So this is our trend line. Trend lines basically simplify the direction of movement of the market. However, trend lines can be subject to interpretation, same way as support and resistance is. But I might look at the chart and I might think that the trend line is here. Someone else might look at the chart and think that this here is the actual trend. All right, so it's subject to resistance. And so, like I said, the trend line is basically a diagonal area that serves as either support or resistance. And you identify your trend line by looking at the pattern of movement of price action, the overall direction, and you want price to touch that trend line at least 3 times. Right? So as we can see here, consider this as one touch, this as two touch, this as three touches. So this is your trend line. And if we extend it all the way up, we can see that price comes back to this area consistently. It doesn't break the area very often, and it continues to follow that directional movement, being careful not to break this trend line at any point. So that is our trend line. So it serves as an area for price to resist or price to reject. So trend lines, put another way, can be seen as diagonal areas that price reject as they move in a particular direction. Now, these are important in swing trading. When you put together your areas of support, areas of resistance, and your trend line, you have areas there that you can expect price to move off of or to reject. So resistance is an area above that price rejects. A support is an area below that price rejects. And a trend line is a diagonal area that price rejects. Now, very important. When a diagonal area of resistance, that being a trend line, intersects an area of support or an area of resistance, it therefore means that you have a confluence of areas that price usually rejects. So if we know that price rejects an area of support, and if we know that price rejects an area of resistance, it then follows logic that if we have a point at which that trend line crosses that area of support or area of resistance, then in that area, when price reaches that area, there's a stronger likelihood that price is going to reject that area. And we see that happening right here. Our trend line crosses or dissects our area of support. And when price gets to that point where it meets both the area of support and the trend line at the same time, price rejects that area and gives us a move in a direction opposite of that support. Now, should be true here as well, because we have our area of resistance and our trend line crosses it. So what should happen? We should have expected price to reject and go upwards. That didn't happen because price is now changing its momentum or its direction altogether. If price had rejected this area here, it means that price would have continued in that bullish trend. It did not, it broke through the area, came back the area, still wasn't able to go higher, and continued to sell downwards. Now, because of this, we can tell that price has changed direction. So at this point, the market is no longer bullish, but rather it's bearish. This confirms that there's a change in direction, right? And that's where trading becomes difficult and unpredictable because nothing is absolutely true 100% of the time. We just said when two areas of rejection crisscross, that be an area of support is crossed by a trend line, it should mean that there's a strong rejection at that area, and there is. But here we get it, the same thing happening once again, and there was no rejection. So our formula fails, so to speak, but not exactly, because price cannot continue going up indefinitely. When we see things like that happen, it's highly likely that the trend of the market is changing. And so the market is moving from, if it was bullish, it's going to move to bearish. If the market was bearish, it's going to move to a bullish market. So rules get broken when there's often a change in direction of the market. So remember that. But in most cases, rules like these are followed. Not 100% of the time, but often enough for us to be able to somewhat predict the movement and take trades based on those predictions.